Welcome back. Today we're looking at something extraordinary, one of America. As largest foreign creditors is locking in losses that would have been unthinkable just a few years ago. And if you are watching global capital flows closely, this is the kind of move that should make you pause, question the narrative, and keep listening. This content is for informational and educational purposes only and should not be considered financial advice. When people see the phrase, the $688 billion exit, it is easy to misinterpret it as a sudden liquidation or a dramatic overnight vote of no confidence. That is not what the data actually shows. What this figure represents is the cumulative reduction in China's holdings of U.S. Treasury securities from their peak levels, measured over more than a decade of gradual adjustment. At its high point in the early 2010s, China was the single largest foreign holder of U.S. government debt, with Treasury holdings exceeding $1.3 trillion. That position was not ideological. It was a byproduct of persistent trade surpluses, managed exchange rates, and a global system that recycled dollar inflows back into U.S. sovereign debt as the deepest, most liquid reserve asset available. In that context, Treasuries functioned less like an investment and more like settlement collateral for the global dollar system. What has changed is not the existence of Treasuries themselves, but China's willingness to concentrate reserves so heavily in one jurisdiction, under one legal and political framework. Over successive reporting periods, official disclosures show a steady drawdown, sometimes masked by custodial shifts or indirect holdings, but persistent nonetheless. The $688 billion figure simply marks how far that process has now gone. Seen this way, the story is not about a sudden break, but about a slow rebalancing that has reached a scale large enough to attract attention. It reflects evolving risk assessments, reserve management priorities, and trust considerations within the existing financial architecture. If you find this kind of structural shift more informative than daily price movements, it's worth staying engaged with the data and sharing your perspective in the discussion. To understand why China accumulated such a large position in U.S. Treasury debt, you have to place yourself in the mechanics of the global system as it functioned in the late 1990s and early 2000s. China was running persistent trade surpluses with the United States and much of the developed world. Those surpluses generated large inflows of dollars. The question was never whether to recycle them, but where. At the time, managing the exchange rate was a central policy objective. By purchasing dollar-denominated assets, Chinese authorities could prevent excessive appreciation of the renminbi, protecting export competitiveness and domestic employment. U.S. Treasuries, by virtue of their depth and liquidity, became the default instrument for this process. They were not chosen for yield maximization, but for balance sheet stability and operational convenience. Reserves in that framework functioned less like a profit-seeking portfolio and more like insurance. Treasuries provided a highly liquid store of value that could be mobilized quickly in a crisis, collateralized across the global financial system, and marked as effectively risk-free under prevailing regulatory assumptions. After the global financial crisis, that logic appeared reinforced. Despite originating in the U.S. financial system, the crisis ended with even greater central bank reliance on dollar liquidity and U.S. sovereign debt as the anchor of global settlement. In a near-zero interest rate environment, opportunity cost was muted. Holding long-duration government bonds did not look reckless when inflation was subdued. Yields were compressed globally, and alternative reserve assets lacked scale or convertibility. The system rewarded size and conformity, not diversification. In that context, China's treasury accumulation was not a speculative bet on U.S. fiscal discipline. It was a rational response to the structure of the dollar-based system as it existed. Understanding that starting point matters, because it clarifies that any subsequent reduction in holdings reflects changing system incentives, not a retroactive judgment that the original strategy was irrational. If you're evaluating these shifts through that structural lens, it's worth continuing the conversation and comparing interpretations with others who are watching the same underlying dynamics. For more than a decade after the global financial crisis, the global interest rate environment was defined by suppression rather than discovery. Policy rates hovered near zero, central banks expanded balance sheets, and duration risk was treated as a manageable, almost abstract concept. In that world, holding long-dated sovereign debt carried little visible penalty. Price volatility was muted. Refinancing was easy, and mark-to-market losses were largely theoretical as long as bonds were held to maturity. That regime did not end abruptly, but it did end decisively. As inflation pressures re-emerged across developed economies, central banks were forced to reassert control over credibility. The result was one of the fastest and most synchronized tightening cycles in modern history. Policy rates rose, balance sheet expansion reversed, and yield curves repriced accordingly. What had been a tail risk for years became a front and center constraint. Bond math is not ideological, and it is not negotiable. When yields rise, the market value of existing bonds falls. The longer the duration, the greater the sensitivity. This is not a matter of poor timing or misjudgment. It is the mechanical relationship embedded in fixed income instruments. For large holders with significant exposure to long-dated treasuries, unrealized losses accumulated quietly as rates climbed. Those losses only became visible when positions were reduced or rebalanced. This is where the distinction between accounting comfort and economic reality matters. For years, low rates masked duration risk in the same way stable weather masks structural weaknesses in a building. The structure appears sound until conditions change. Once yields reset higher, the embedded losses could no longer be ignored by institutions that needed liquidity, diversification, or flexibility. For reserve managers, the choice was not between profit and loss, but between concentration and optionality. Continuing to hold large volumes of low-coupon bonds in a higher rate environment meant accepting reduced real returns and increased opportunity cost. Reducing exposure meant crystallizing losses, but also restoring balance and adaptability. From this perspective, the losses associated with selling are not anomalies. They are the delayed recognition of risk accumulated during an artificially prolonged rate environment. The tightening cycle did not create the problem. It revealed it. Understanding that distinction is critical because it reframes recent selling not as panic or error, but as a rational response to a structural regime change. If this line of reasoning resonates, consider staying engaged with the broader discussion and contributing your own analysis as these dynamics continue to unfold. When large bondholders sell into a higher rate environment, the losses that appear in the headlines are often described as if they were the result of poor judgment or sudden error. In reality, those losses are the visible endpoint of a process that began years earlier, embedded in the structure of fixed income instruments themselves. Understanding that mechanism is essential to interpreting what is actually happening. A bond is, at its core, a fixed set of future cash flows. The market assigns a price to those cash flows based on prevailing interest rates. When rates are low, existing bonds with higher coupons look attractive and their prices rise. When rates rise, new bonds offer higher yields and older bonds must trade at a discount to remain competitive. This adjustment happens continuously, whether or not the holder chooses to look at it. Duration measures how sensitive a bond's price is to changes in interest rates. Longer duration bonds, such as long-dated treasuries, experience larger price swings for a given move in yields. During the low-rate era, duration risk was tolerated, even encouraged, because volatility was suppressed and central banks were active buyers. As rates normalized upward, that same duration became a source of unavoidable mark-to-market pressure. If a holder never sells and holds the bond to maturity, those losses remain unrealized. The bond pays out as promised, and accounting statements can obscure the economic cost. But reserve managers and sovereign institutions do not operate in a vacuum. They rebalance, meet liquidity needs, and adjust portfolios as conditions change. The moment a bond is sold, the gap between its purchase price and its current market value becomes a realized loss. That realization is not a failure of strategy. It is the cost of regaining flexibility. Selling into a higher rate environment means accepting today's valuation in exchange for reducing concentration risk, freeing capital, or reallocating into assets with different risk profiles. It is a trade-off between preserving nominal accounting comfort and responding to a changed reality. From a systems perspective, these losses reflect deferred price discovery. Years of suppressed rates delayed the recognition of duration risk, much like insurance premiums that seem unnecessary until a claim is filed. When selling occurs, the loss looks sudden, but its origins are historical. Interpreting these events through that lens helps avoid simplistic conclusions and keeps the focus on incentives, structure, and long-term credibility. If this framework aligns with how you analyze markets, continuing the discussion and exchanging views can add depth to the conversation. When evaluating why a sovereign actor might accept realized losses on a portfolio as large and visible as U.S. Treasuries, it helps to step away from investment framing altogether. For reserve managers, the primary objective is not return maximization, but system resilience. In that context, losses are not automatically disqualifying if they serve a broader strategic purpose. One plausible motivation is reserve diversification. Concentration risk becomes more problematic as political, legal, and monetary frameworks evolve. Holding a large share of reserves in a single sovereign market exposes an institution to policy decisions over which it has no control. Gradually reducing that exposure, even at a financial cost, can be understood as paying a premium for optionality. Much like exiting an illiquid position during a regime change, the price paid reflects current conditions, not necessarily the wisdom of the decision. Liquidity considerations also matter. Reserves are meant to be deployable under stress. Long-duration bonds in a volatile rate environment can behave unpredictably when liquidity is actually required. By reallocating away from assets with high duration sensitivity, reserve managers may be prioritizing reliability over yield, especially when domestic financial stability becomes a higher priority. Geopolitical risk management is another layer that is difficult to quantify but impossible to ignore. The past decade has demonstrated that financial assets are not always politically neutral. Sanctions, asset freezes, and jurisdictional reach have altered how sovereigns assess counterparty risk. Reducing exposure to assets governed by foreign legal systems can be seen as a form of balance sheet de-risking, even if it carries near-term accounting costs. Domestic economic pressures further complicate the picture. Slowing growth, property sector stress, and capital flow management can all influence reserve policy. Selling foreign assets may provide flexibility to support domestic objectives, stabilize currency dynamics, or manage financial conditions at home. In that sense, Treasuries function less like a long-term holding and more like a buffer that can be drawn down when internal priorities shift. Taken together, these factors suggest that realized losses are not the sole metric guiding decisions. They are one input among many, weighed against political autonomy, liquidity assurance, and systemic exposure. From this angle, the behavior looks less like a market call and more like institutional risk management under changing constraints. Understanding these motivations helps avoid the trap of interpreting sovereign actions through a purely profit and loss lens. For viewers who approach markets through incentives and structure rather than surface narratives, this broader framework offers a more consistent explanation. If this perspective adds clarity, consider staying engaged with the analysis and contributing your own observations as these strategic adjustments continue to evolve. When headlines focus on a major holder reducing exposure to U.S. Treasuries, the immediate reaction is often to assume a direct threat to the stability of the market itself. That reaction confuses symbolic signal with functional impact. The two are related, but they are not the same thing, and failing to separate them leads to overstated conclusions. The U.S. Treasury market is not just large, it is foundational. It is the deepest and most liquid sovereign debt market in the world, embedded into collateral frameworks, regulatory capital rules, and global funding mechanisms. Daily trading volumes routinely absorb flows that would overwhelm most other asset classes. In that context, even a sizable seller does not operate in a vacuum. Other actors, domestic institutions, pension funds, banks, insurance companies, and central banks, participate for reasons that extend beyond short-term valuation. This is why reductions by one holder do not automatically translate into disorderly markets. Supply can be reabsorbed, yields can adjust, and price discovery continues. We have historical precedent for this. Periods of foreign selling have occurred before without breaking the system, largely because treasuries serve functions that go beyond portfolio allocation. They are used as collateral, as balance sheet anchors, and as liquidity instruments in stressed environments. That said, dismissing the move entirely would also be a mistake. The signal matters, even if the immediate mechanical impact is muted. When a long-term holder reduces exposure persistently, it raises questions about incentive alignment and confidence over time. Markets can absorb flows, but they cannot ignore shifts in behavior from institutions that previously acted as structural buyers. The distinction is similar to that between spot pricing and underlying market health in precious metals. A futures price can remain stable while physical premiums widen, indicating stress beneath the surface. Likewise, treasury yields can clear the market while long-term demand composition quietly changes. The system continues to function, but the character of participation evolves. From a systems perspective, the key issue is not whether treasuries will continue to trade, they will, but who is willing to hold them under what conditions and with what expectations. That is a slower moving process, one that plays out through balance sheets rather than headlines. Understanding this distinction allows for a more measured interpretation. The reduction of holdings is not an imminent destabilizer, nor is it meaningless. It is a data point within a broader pattern of incremental adjustment. For those analyzing credibility, trust, and structure rather than daily price moves, that nuance is where the real information resides. If this framing is useful, staying engaged and comparing interpretations with others can add depth as these shifts continue to develop. The most important takeaway from this episode is not the size of any single transaction, or even the cumulative reduction itself, but what it suggests about how the global financial system is slowly reorienting. Framing this as China exiting U.S. debt oversimplifies a process that is more gradual, more structural, and ultimately more revealing. Since the aftermath of 2008, the international monetary system has operated on a set of assumptions that went largely unquestioned. Dollar liquidity was abundant, U.S. sovereign debt was treated as politically neutral, and global reserves clustered around a narrow set of instruments. Trust was implicit, embedded in institutions rather than continuously tested. What we are seeing now is not a rejection of that system, but a quiet reassessment of its concentration points. Reserve diversification, in this context, is less about optimizing returns and more about reducing single-node dependency. When reserves are heavily concentrated, they function efficiently under stable conditions, but become brittle when conditions change. The gradual reallocation away from any one asset class or jurisdiction suggests an attempt to introduce redundancy, much like engineering systems that trade efficiency for resilience. This shift also reflects evolving perceptions of financial interdependence. Globalization once implied mutual benefit and shared incentives. Increasingly, it is being recalibrated through the lens of strategic autonomy. Financial assets are no longer evaluated solely on liquidity and creditworthiness, but on governance, jurisdictional risk, and policy alignment. That does not require a crisis to unfold. It only requires enough precedent to alter behavior at the margins. The parallel to physical versus paper markets is instructive. On the surface, price signals may appear orderly, but beneath that surface, participants adjust how much trust they place in abstractions versus control. In reserve management, this translates into questioning how assets behave under stress, how quickly they can be mobilized, and under whose authority. None of this implies an imminent breakdown. Systems rarely fracture all at once. They evolve through incremental decisions made by institutions responding to changing incentives. Each individual adjustment is defensible in isolation. Taken together, they point to a slow reconfiguration of the post-2008 financial order. This is the turning point worth paying attention to, not because it guarantees a specific outcome, but because it changes the baseline assumptions that underpin global finance. For those focused on structure, credibility, and long-term trust, rather than daily volatility, this is where the signal resides. As always, engaging with these developments critically and comparing interpretations across different frameworks helps build a more complete understanding of where the system may be headed next. If this gradual reconfiguration continues, the most likely effects will not appear as sudden market dislocations, but as subtle changes in how global capital moves and where it chooses to reside. Reserve diversification, by its nature, unfolds slowly. Central banks and sovereign institutions tend to operate on long time horizons, adjusting allocations incrementally to avoid destabilizing the very systems they rely on. As a result, the implications are more about direction than destination. One potential outcome is a more fragmented reserve landscape. Instead of a dominant concentration in a small set of assets, reserves may become distributed across a wider mix of currencies, maturities, and jurisdictions. This does not require the displacement of the dollar or U.S. Treasuries as central pillars. It suggests a gradual reduction in their exclusivity. In such an environment, trust becomes less binary and more conditional, assessed continuously rather than assumed by default. Over time, this could influence borrowing costs at the margin. When demand is more diversified and less structurally anchored, pricing becomes more sensitive to policy credibility, fiscal discipline, and institutional stability. These effects are unlikely to be dramatic in the near term, but they may accumulate, altering the baseline from which rates are set. In that sense, borrowing costs reflect not just inflation expectations, but confidence in governance and predictability. Geopolitical finance also becomes more nuanced under these conditions. Financial relationships that once appeared apolitical are increasingly evaluated through strategic lenses. Capital flows may respond more quickly to shifts in diplomatic alignment, regulatory reach, or sanction risk. This does not imply constant volatility, but it does suggest that capital is becoming more selective about where it accepts long-term exposure. The analogy to physical versus paper markets remains useful. Even when quoted prices appear stable, underlying behavior can change as participants reassess counterparty risk and delivery assumptions. In sovereign finance, this reassessment plays out through reserve composition, custodial choices, and asset liability management rather than visible price spikes. Importantly, none of these implications point to an inevitable outcome. Systems adapt, incentives evolve, and historical patterns rarely repeat in exact form. What can be observed is a shift away from unquestioned concentration toward measured optionality. That shift carries trade-offs, including higher complexity and potentially lower efficiency, but also greater resilience. For those focused on long-term structure rather than short-term signals, the value lies in watching how these adjustments compound over time. Tracking changes in reserve behavior, funding patterns, and institutional preferences offers more insight than reacting to any single data point. Continuing to analyze these developments with patience and skepticism is often more productive than drawing premature conclusions, and engaging in thoughtful discussion helps refine that process. Stepping back from the individual data points, the most useful takeaway is not found in the size of the losses or the pace of selling, but in the behavior behind them. In complex financial systems, actions often communicate more clearly than statements. Watching who is willing to absorb losses, under what conditions, and in pursuit of which objectives tends to reveal more about underlying confidence than any headline narrative. Losses, in this context, are not admissions of failure. They are signals of changing priorities. When institutions accept near-term financial costs to alter exposure, it suggests that non-financial risks, concentration, jurisdiction, liquidity, or political uncertainty, have begun to carry more weight in decision-making frameworks. That shift does not happen impulsively. It reflects accumulated experience, precedent, and evolving assessments of trust. This is why focusing exclusively on price action or monthly holdings data can be misleading. Markets clear every day, but systems change over longer cycles. The important developments often occur in the background through incremental reallocations and policy adjustments that only become visible after they have been underway for some time. By the time they register as news, the underlying logic is usually already established. For those accustomed to analyzing precious metals, the parallel is familiar. Paper prices can remain stable even as physical demand, delivery preferences, and custody choices evolve. The surface looks calm, while behavior beneath it shifts. Sovereign finance operates in a similar way. The mechanics function, liquidity persists, but trust is gradually repriced through institutional choices rather than sudden breaks. None of this implies a predetermined outcome. Financial history is not linear, and systems adapt as incentives change. What matters is maintaining clarity about what is actually being signaled. In this case, the signal is not an imminent collapse or a dramatic exit, but a reassessment of exposure in a world where assumptions about neutrality, permanence, and alignment are no longer taken for granted. Approaching these developments with patience and discipline is essential. Drawing conclusions too quickly risks mistaking noise for structure. Observing behavior over time and placing it within historical context provides a more reliable framework for understanding where stress may accumulate and where resilience is being built. If you have your own interpretation of what these shifts represent, sharing that perspective adds value to the discussion. If deeper, system-level analysis is useful to you, continuing to follow this work can help refine how these patterns are understood. Above all, staying engaged, skeptical, and attentive to incentives rather than narratives remains the most effective way to navigate an evolving financial landscape.